This is Optimal Finance Daily, episode 1992, Payday Loans versus Credit Cards by J.Money of budgetsaresexy.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get to today's post as we optimize your life. Payday Loans versus Credit Cards by J.Money of budgetsaresexy.com. Payday loans versus credit cards. Which are worse to take cash out from? They both have their pros and cons, mainly cons. But if you were in a bind and had to pick one, which would it be? This debate popped up during my coffee meetup with James from Dinks Finance last night. I told you I'd be blogging about it. But the crazy thing here was that we found ourselves defending opposite sides. He was slamming credit cards, and I was quick to diss those payday loans. It was an epic battle of two finance bloggers going head to head, or perhaps a battle of nerds sipping coffee. Take your pick. The question we have to ask ourselves here, though, of course, is who's right? Or better yet, which product technically is the worst of the two? Well, I'm no expert in the field, but this little quote found on the CFA's or Customer Federation of America's website says it all. Quote, "Payday loans are extremely expensive compared to other cash loans. A $300 cash advance on the average credit card repaid in 1 month would cost a $13.99 finance charge and an additional interest rate of almost 57%. By comparison, a payday loan costing $17.50 per $100 for the same $300 will cost $105 if renewed one time, or 426% annual interest," end quote. Ka-ching! They also share a pretty interesting cost comparison chart and a loan calculator that helps to determine what your total cost would be. By the way, for those who aren't familiar with the term payday loan, it's basically a small short-term loan that's intended to cover a borrower's expenses until their next payday, sort of like a cash advance, also referred to as a paycheck advance or payday advance. They can be taken out online or at physical stores like pawn shops or their own entities. In fact, it goes without saying that neither payday loans or credit cards are a good answer for getting cash. Borrowing money from family or friends, taking out a personal loan, or just dipping into your savings accounts always trumps cash advances when it comes to the fees you'll have to pay. Unfortunately, there are times when those aren't an option though. And thus the reason for this post, other than to prove my man James wrong. Contender number 1, payday loans. The average fee you'll pay for a payday loan is somewhere between $17 to $25 for each $100 that you take out, but it can get as high as $30 per $100 in some states. So say you take out a common advance of $500 and you pay it back in full after 2 weeks. Great. You had to pay an extra $87.50 on top of the $500 you borrowed, but at least it's over with, right? Unfortunately, no. The odds are stacked against you. According to the CFA, quote, consumers have an average of 8 to 13 loans per year at a single lender, end quote. That's pretty scary. On the plus side, you could argue that since these are mini loans of 2 weeks at a time, it might be easier to pay off and not have it drag on like it may with a credit card. That all comes down to personal preference and usage though. I can't really relate to it here. Then of course we have that big old stereotype that payday lenders are bad, evil people that are out to steal your money. Well, I don't have any facts myself to say that they're shady, although I feel they are, but I can definitely say without a doubt that they want your money. And unfortunately, you're hard-pressed to see all their fees up front and readily accessible on their sites, at least on the non-reputable ones. And contender number 2, credit cards, or cash advances from credit cards. Now let's talk credit cards. As much as I champion my dear credit card for budgeting purposes and the cash back rewards, not to mention the free grace periods to pay back purchases, there's certainly no angels either. According to common knowledge and the talking heads on TV, the average American household is in about $8,000 of debt. Some feel this is a bit inaccurate, but the fact is that many of us are indeed addicted to our credit cards. And if you're already addicted, why not just slap on cash advances to it, right? While usually less than Payday's, do your research, you'll still pay a steep price for it, anywhere from 15 to 25%. Of course, there's also the problem of mixing and matching normal purchases with cash advances. Most cards, if not all, will use your payments to pay off the lower interest items first, like your purchases, and then use it to pay off the higher cash advanced amount. It looks like there may be some new rules in place soon that would get rid of this, though. On the other hand, most credit card companies display all the information up front, the rates, the fees, etc. You might actually have to look for it, but it is there, and usually written in itty-bitty font. I believe most credit card statements have it all disclosed on the back, but either way, it's easily accessible on your bank's website or by placing a 2-minute phone call. If you do your research and check around for the best rates, you might be surprised at what you can find. The winner? Credit cards. In conclusion, they both suck and should be avoided like the plague. But if forced to take one over the other, I'd go with my credit card all the way. I'm comfortable with it, I have a good relationship with the bank that issues it, and I could easily go online and pay the advance off at any point because I don't carry any other balance. And if I did, I could always take out a new card specifically for this purchase and then pay it off online. Now, if only I could remember the reasons James argued for payday loans. I'll have to ping him and get him to respond back here. Although in all honesty, I'm scared as that boy's a genius at analyzing. Seriously, have you ever checked out any of his posts? Whew. You just listened to the post titled Payday Loans versus Credit Cards by J.Money of budgetsaresexy.com. This article made me reflect on the various predatory lending practices out there. According to debt.org, predatory lending is any lending practice that imposes unfair or abusive loan terms on a borrower. It's also any practice that deceptively convinces a borrower to accept unfair terms for a loan that a borrower doesn't need, doesn't want, or can't afford. An example of this is when a lender hides in the fine print or misrepresents the true costs, risks, and/or appropriateness of a loan's terms, or the lender changes the loan terms after the initial offer. One of the most common practices among predatory lenders is loan churning, where the borrowers are forced into a relentless loan cycle in which they're constantly paying fees and interest without noticeably reducing the principal amount owed on the loan. Loan churning usually works like this. The lender makes a loan the borrower can't afford. The borrower fails to pay the loan back on time, so the lender offers a new loan that includes another set of fees and interest. The borrower, already under stress from not repaying the first loan, agrees to the second loan, and the loan cycle churn has started. The Consumer Financial Protection Bureau says that 94% of repeat payday loans happen within 1 month of the first loan, and that consumers using payday loans borrow an average of 10 times a year. The interest and fees amount to $2.1 billion for borrowers. Borrowers often end up paying $450 in interest alone for a $350 principal because of loan churning. It's commonplace among predatory lenders and something consumers with a poor credit history should be on guard against. And that will do it for today. Have a great day and start to your weekend. Thank you for listening, and I'll be back here reading to you tomorrow, where your optimal life awaits.